Alright, besties, gather round. In a world of rocket to the moon crescent moon gurus, day trading bros flexing their Lambos, probably rented, and the endless TikTok parade of get-rich-quick schemes, there's a quiet whisper. It's the sound of actual wealth being built, slowly, steadily, and without needing you to sacrifice your sanity. Today, we're ripping off the Band-Aid and exposing the biggest lie in retail investing, that you need to pick individual stocks to get rich. Spoiler alert, you don't. And frankly, most of you shouldn't. We're diving deep into the utterly mundane world of index funds versus the high-octane, high-stress, usually low-return circus of stock picking. This is going to be good. Let's be real. Why do we all secretly want to be the next Warren Buffett? Because it sounds cool, right? You pick that one underdog stock, it goes parabolic, and suddenly you're chilling on a yacht named Stonks Only Go Up. It's the ultimate main character fantasy. We see the headlines about Apple, Tesla, Nvidia, these behemoths that made early investors obscenely rich. And our lizard brains go, I can do that. I just need to find the next Apple. Except, you can't. Or rather, the odds are so astronomically stacked against you, it's practically a lottery. Think about it, who's telling you to pick stocks? Is it the guy who actually made billions, or the influencer who makes money by telling you to pick stocks, probably using affiliate links to some shady brokerage? Professional fund managers, with teams of analysts, billion-dollar research budgets, consistently fail to beat the market. We're talking like 85 to 90% of actively managed funds underperform their benchmark over a 15-year period. Let me repeat that. Professionals with all the advantages you can dream of, fail. And yet, Kevin from accounting, after watching a 30-second TikTok, thinks he's got the cheat code. Honey, no. That's not confidence, that's delusion. The market is not a casino where you can feel a win coming. It's a complex system, and trying to outsmart it is like winning a staring contest with the sun. You're gonna get burned. So, if stock picking is a fool's errand for 99% of us, what's the alternative? Enter the index fund. Collective gasp of boredom. I know. It sounds like something your grandma invests in. And guess what? Your grandma is probably richer and less stressed than the day traders in their Reddit forums. What is an index fund? Simplest way to think about it, it's a giant basket. Instead of buying one apple, you buy a tiny slice of every apple in the entire orchard. An index fund, typically an exchange-traded fund or ETF, holds a diversified portfolio of stocks or bonds that mimic a specific market index. The most famous one? The S&P 500. It tracks the performance of the 500 largest publicly traded companies in the United States. So, when you buy an S&P 500 index fund, you're buying a tiny piece of Apple, Microsoft, Amazon, Google, you get the picture. You own a piece of America's economic engine. All 500 companies, in proportion to their size. Here's the magic, you don't need to pick winners or predict busts. You're betting on the collective growth of the market itself. If the US economy continues to grow over the long term, your index fund grows with it. History tells us the market always grows over the long term. There are dips, sure, recessions, pandemics, but the market eventually recovers and continues its upward march. It's like having a seat on every single winning rocket ship, instead of building your own from scratch. Alright, enough with the analogies, let's get down to brass tacks, the actual numbers. Because while quiet wealth sounds nice, more money sounds even better. Historically, the S&P 500 has averaged about a 10 to 12% annual return before inflation over the very long term. Some years it's up 20%, some years it's down 15%. But if you just ride the waves, hold tight, and don't panic sell, that's roughly your reward. Now, let's compare that to our intrepid stock picker. To consistently beat the market, you don't just need to pick one winner, you need to pick multiple winners, year after year, and avoid all the losers. It's an insane challenge. Then there are fees. This is where active management absolutely murders your returns. An actively managed mutual fund might charge you 1 to 2% in expense ratios annually. That might not sound like much, but over decades, that 1 to 2% eats away at your compounding like a tiny, insatiable goblin. An S&P 500 index ETF. Think 0.03% to 0.09%. We're talking fractions of a percentage point. Let's do some quick back-of-the-napkin math. Imagine you invest $10,000. Asterisk scenario A, actively managed fund with a 1.5% fee, yielding 8.5% net return, assuming they even match the market before fees. Asterisk scenario B, S&P 500 index fund with a 0.05% fee, yielding 9.95% net return, assuming the market returns 10%. After 30 years, assuming you never add another dime. Asterisk scenario A, $115,000. Asterisk scenario B, $171,000. That's a $56,000 difference for doing less work, having less stress, and not paying some suit in Manhattan to underperform. And this is just on the initial $10,000. Imagine if you were adding $500 a month to that. The difference would be astronomical. This isn't just theory, it's the undeniable power of compounding returns and low fees. These small fees, compounded over decades, become monumental losses. Index funds are like having a financial autopilot that avoids all hidden fees and keeps you on the optimal flight path. But it's not just the math, it's also your squishy, irrational human brain. Behavioral finance tells us we are our own worst enemies when it comes to investing. Asterisk fear of missing out, FOMO. Everyone's talking about Dogecoin going up 1000%. You jump in, right at the peak, and then it crashes. Index funds remove the FOMO because you already own a piece of everything. When a hot stock like Nvidia is booming, your S&P 500 fund already has it. You're participating without the drama. Asterisk overconfidence. Asterisk, I'm smarter than the market. No, you're probably not. Most people vastly overestimate their ability to predict market movements or identify undervalued stocks. This leads to excessive, costly trading. Asterisk emotional trading. Asterisk market dips. Panic sell. Market soaring. Get greedy, buy more high-risk stuff. Our emotions are terrible financial advisors. Index funds encourage a set it and forget it approach. You're buying the whole hayfield, so you don't need to worry about individual needles. You simply keep investing, consistently, through highs and lows, trusting the long-term trend. Asterisk anchoring and confirmation bias. Asterisk you buy a stock at $100. It drops to $50. You anchor to that $100 price and refuse to sell, hoping it will return, even if the underlying company's fundamentals have changed. Or you only seek out news that confirms your belief about a stock, ignoring contradictory evidence. Index funds shield you from these cognitive traps. Your focus isn't on a single company, but the aggregate, letting the entire economy work for you, not just a meme stock. So, you're convinced. You want to ditch the TikTok gurus and embrace the quiet wealth. Great choice, you smart cookie. How do you actually do this? It's ridiculously simple. 1. Open a brokerage account. Asterisk if you don't have one, get one. Fidelity, Vanguard, Charles Schwab, reputable brokers with low or zero ETF trading fees. For retirement, max out your 401k or Roth IRA, tax advantages are king. 2. Choose your index fund. For most people, especially beginners, an S&P 500 index fund is an excellent starting point. Popular choices, these are ETFs, easy to buy. Asterisk VOO, Vanguard S&P 500 ETF. Asterisk SPY, SPDR S&P 500 ETF Trust. Asterisk IVV, iShares Core S&P 500 ETF. If you want even broader market exposure, including smaller companies. Look at a total U.S. stock market fund like VTI, Vanguard Total Stock Market ETF, or a total international market fund like VXUS, Vanguard Total International Stock Index Fund ETF, for global diversification. A simple portfolio might be 70% VOO/VTI and 30% VXUS. Don't overcomplicate it. 3. Set up automated investments. Dollar cost averaging. Decide how much you can invest each month. Set up an automatic transfer from your bank account to your brokerage, and an automatic purchase of your chosen ETFs. This is dollar cost averaging, buying more shares when prices are low, fewer when high, smoothing your average price, removing emotion, ensuring consistent investment. 4. Hands off. Mostly **** resist the urge to constantly check your portfolio. Resist the urge to jump in and out based on market news. This is a long-term game. Unless your financial situation drastically changes, e.g., retirement, major life goal, just let it ride. Review annually, rebalance if needed, but otherwise, chill. Go live your life. This is the quiet part of quiet wealth. So why bother with this boring strategy? Because it's not just about money, it's about freedom. Freedom from stress, freedom from endless research, freedom from market anxiety. Peace of mind. You're not waking up in a cold sweat wondering if your single stock bet is going to tank. You know that even if one or two companies in your S&P 500 index fund go bankrupt, the other 498 will likely pick up the slack, or be replaced by new, stronger companies. You are maximally diversified, owning a piece of the entire global economy. Time savings. Think about how much time people spend researching stocks, reading Reddit forums, watching analyst videos. With index funds, your research is done. Pick your funds, set your automation, and spend that extra time on things that actually matter: your hobbies, your family, your career, literally anything else. Superior returns, for most. Let's be blunt. For the vast majority of retail investors, index funds will outperform their individual stock picks over the long term. This is a statistically proven fact. Don't fall for the "but what if I find the next Google" trap. The probability is infinitesimally small. It's not worth the risk, time, or emotional toll. Simplicity. This is the easiest, most straightforward way to invest. No complex algorithms, no high-frequency trading, no derivatives. Just buy the market, consistently, and let time and compounding do the heavy lifting. It's investing for actual adults, not for people cosplaying as Gordon Gekko. So, there you have it, future financially secure humans. The secret to quiet wealth isn't some complex strategy or a hot stock tip. It's embracing the mundane. It's acknowledging you're not a hedge fund manager, and probably don't want to be. It's about letting the market work for you, not trying to outsmart it. Ditch the hype, the stress, and the impulse to treat investing like a video game. Embrace the power of index funds. Set it, forget it, and watch your actual wealth grow. Your future self, chilling on a non-rented yacht, or comfortably retired, will thank you. Now go forth, be boring, and get rich. And maybe unfollow that one financial guru promising 1000% returns on a penny stock. Just saying. Like, subscribe, share this with someone still stuck in the stock picking matrix. Peace out.